Okay, so this is Amazon's section of equity, and they're on their what financial statement is this found on? What is the balance sheet? Assets equals liabilities plus equity. This is basically the equity section. So yes, it's from the balance sheet. Okay, so um, you can see a little more detail. Okay, it's this par value. Okay, we're going to talk about what that is. This you can see is low. This you can see is very high. Additional paid-in capital. We're going to see how these two accounts are related in a second. What is 100,000 times a million? 100 billion, yeah. So, which is a totally arbitrary number. Okay, there's 100 billion shares authorized. There's 10.827 billion shares outstanding. So, as of December 31st, 2025. So, here's a little math. Okay, this is key concepts. So everyone pay attention to this. I think this is an easy one to misunderstand. You have this many shares that are outstanding that investors own. If you looked on December 31st, 2025, or the last trading day before that, because it's a holiday, the price per share was $230.82 per share. This price per share times 10.827 billion is $2.47 trillion. So this essentially represents the total market capitalization of Amazon. Okay, the price per share times the number of shares outstanding. Does that conceptually make sense? Right? So this is what the market is saying that the equity, the stockholders' equity is worth. Okay, so now if we look at the balance sheet, it's only 411 billion. So what is accounting for this difference? The stock market is saying stockholder equity is worth 2.47 trillion. The balance sheet, which includes retained earnings, all the contributed capital, it's only 411 billion. Why is there such a massive difference? That's true. Okay, good point. So one point is maybe I took $100 at the beginning of my company when I first started, and then I never took a single dollar of paid-in capital or contributed capital. My businesses grew from there. But then you would see that, well, I've only earned 250 billion total. Okay, so how about this? I gave you guys the story of Instagram, right? Before they had any revenue, they were bought for $1 billion. So their equity, stockholders' equity section of their balance sheet would have been a negative, retained earnings would have been negative. Yet it got bought for $1 billion. And maybe their stockholder equity would have said $10 million. So why was there such a big gap between what Facebook paid and what the accounting balance sheet showed? Yeah, goodwill. All Amazon has all these technologies that uh, aren't really. They have kind of like a huge market leading kind of market share of e-commerce. All these things are intangibles. Okay, the market is also pricing in future growth. The market is also pricing in the fact that if you looked at their income statement, the net income is lower because they spend so much on R&D and all these other things for future growth. So they're like, well, if Amazon really wanted to, they could cut their costs and increase their retained earnings by much more by being far more profitable. So the market is looking at the business in totality, not just what's on the accounting statements, and coming to a value. And a lot of it is, of course, hype, The stock market just hypes up certain companies too. So you could argue that 2.47 trillion is too high. That could be your opinion as an investor. After looking at the book value, after looking at the income statement, you're like, actually, it should only be worth, yes, more than the book value, which is what this 4.11 billion is, but maybe it should only be 1 trillion. Okay, so this is the difficulty of being an investor, that you have the market giving you some valuation, you have the financial statements giving you some idea of what the company's worth, and your job, this is what people in investment management That's why they get paid the big bucks, because it's very difficult to do, to figure out what is actually the fair value of Amazon. Okay, most most investment managers are actually like follow the herd. Okay, a lot of it is just following the consensus, because the market, this $230 a share is a consensus view. Oftentimes, the consensus view is mostly right, but in order for you to be successful as an investor, you have to figure out when the consensus is wrong, and that's very, very difficult to do consistently. Okay, so $230 is not necessarily the right value for Amazon. It is just the consensus view of those who price this stock. Now, if you have a different opinion, you have to be firm in that conviction, because you're having a different view on it than a lot of high paid people that look at the stock and understand it. Okay? So again, this would be your job as as an analyst. Okay. Okay, so is everyone clear on the difference between book value and market capitalization, market cap as it's called? Market cap is including all the intangible factors that investors will see in the business and ascribe a value to. There are some companies that trade very close to book value, like Berkshire Hathaway. That is there's a range that it trades between, like 1.2 to 1.7 times book value. Okay, Amazon is what? Uh, Not quite 10, 5x book value, right? 6x, 5 to 6x book value. Okay. So, but there are some companies, again, that just the nature of the business, there's not so many intangibles. The book value and the market capitalization follow each other much more closely. And there are some companies that trade under book value. Their market capitalization is less than their book value. So the investors are basically saying the financial statements are overstating the value of equity. Okay, so you'll find all these scenarios within publicly traded companies. Okay, but again, your job is to use the financial statements, use some signal from what the market value is, and figure out what the right value is. Okay, and it's a very difficult job. It takes expertise, it takes understanding of the business, the industry, many things to get good at it. Sometimes it's so blatantly wrong, though. You don't have to know much. Like when COVID first started, there's just a sell-off in everything, even the companies that were totally unaffected by COVID. So in those times, you as a lay person can take advantage too, if you're not scared. But there's many hundreds and thousands of people that are participating in setting that $230 price. It's not just like five people. There's thousands of people that are looking at Amazon stock and know it very well, like professional investment managers. So yes, in some respects, the size of the fund matters, but I think there's like, especially for these huge companies, there's there's a lot of eyes looking at it. It's not like there's like two people determining what it is. Yeah, there are actually, for some smaller companies, that could be the case, where you have very few hedge funds that are like trading in that stock that kind of set the price for it. So that could happen, but I think for these mega large companies, that's very difficult to do. You need so much money to manipulate the price, that it's like for Amazon and these level companies, it's not possible. Okay, so we're gonna see this again. The point of this slide was just to again emphasize the difference between book value and market cap. So I'm hoping that you all understand that very crucial difference. Okay, they're again related, but oftentimes diverge.